In this video, we'll be looking at ETFs or exchange traded funds. We'll be beginning by looking at what is an ETF, why people trade them, the different types of ETFs that are available on exchanges, the advantages as well as the disadvantages of trading ETFs, and at the end I'll be including a video with examples that could be applied in live markets. So let's start by looking at what is an ETF. An exchange traded fund, which is similar to a mutual fund, is a fund traded on an exchange that tracks assets such as indices or indexes, stocks, and commodities. The major ETFs track indexes such as the S&P 500 and the Dow, but there are different types of exchange traded funds that can be very attractive to investors depending on what you're looking for. Just like a mutual fund, an exchange traded fund is managed by a manager. Therefore, a management fee must be paid to the company that manages the ETF you are trading. What an ETF really does is it copies the movements of the asset it is based on. So let's look at why trade ETFs. First of all, there are low costs compared to mutual funds. Just like a mutual fund, you have to pay a management fee to the company that manages the ETF. A big advantage with ETFs and why people like to trade them is that they have stock-like features. So basically, you could buy them on margin, or you could use leverage to purchase them. You could short them, so you can borrow shares and buy them back later on to make a profit. And another very important factor or key factor about ETFs is that you could trade them intraday, which you can't really do with mutual funds. So an example is you could buy an ETF at 10 a.m. and you could sell it back an hour later, which you can do with a mutual fund. Another big aspect of the ETFs is the diversification, which we'll be looking at later on when we look at the different types of ETFs. Now let's take a look at the different types of ETFs. First of all, we have the index tracking ETFs, which are very well known to investors. They track indexes such as the S&P 500, the Dow Jones, and other market indexes. A good example could be the SPY, which is an ETF that tracks the S&P 500. Next up, we have the commodity ETFs, which track commodities such as gold, natural gas, crude oil, and other commodities. For example, GLD and IAU are both gold tracking ETFs, and they're pretty well known to investors. Now for the sector and industry ETFs. The sector and industry ETFs track specific sectors and industries in the markets. Earlier on, we looked at the diversification as being an advantage of ETFs. Instead of trying to find a specific stock in an industry, we can instead cover the industry as a whole and therefore diversify our portfolio. By doing so, if a stock contained in the sector ETF you purchased performs badly, other stocks in the same basket can hedge out the bad stock and make up for it. For example, XLF is an ETF that tracks the financial industry in the US. Now for the Forex or foreign exchange ETFs. The Forex or FX ETFs track currencies such as the pound, the euro, the yen, and other currencies. The bond ETFs track government bonds, treasury bonds, commercial paper assets, and other types of bonds. A good example of a bond ETF could be the BND, which tracks the total bond market in the United States. Now for the last market that we are going to be covering here, the specific market ETFs track markets around the world. A good example could be the GXC, which is an ETF that tracks the Chinese equity or stock market. There are many other types of ETFs, but we won't be seeing them in this video. Some are more advanced and aren't really attractive to retail investors. But you could look them up on the internet and you shouldn't really have any trouble finding them. Now for the advantages of exchange traded funds. Certain ETFs are commission free, which is a pretty big advantage for retail traders that have smaller accounts. Obviously, not all ETFs are commission free. This varies from broker to broker firms, and you should always get informed with your brokerage firm to know which ETFs are commission free. Specific and general market analysis is another advantage of ETFs. Looking back at the previous topic or the types of ETFs, for example, we had the XLF, which is an ETF that tracks the financial industry in the US. If the XLF was up 50% last year, this is an example, don't forget. If the XLF is up 50% last year, this gives us a pretty good idea of how well the financial industry performed in the last year. And it can help us kind of analyze the specific markets. Another example could be the GXC, which tracks the Chinese equity markets. If the GXC was down 30% last year, for example, this could definitely give us a pretty idea of how the Chinese equity market has performed in the past year, how things are doing in China. Now for the market gauge, this is pretty similar to the specific or general market analysis. Really, ETFs give us a good idea of how markets perform. So again, very similar to the specific and general market analysis. Now, differences in NAV are small. NAV stands for net asset value. And I'm actually going to focus on that at the end when we're going to be looking at a live market example, because it's not easy to explain without the use of charts. Now, of course, there are some disadvantages of trading ETFs. On certain exchange traded funds, the spreads can be pretty large, which can definitely be unattractive. If you don't know what a spread is, very basically, it's the difference between the bid and the ask costs. And bad spreads will usually be, you can usually find bad spreads, especially on ETFs that have bad liquidity or kind of lower volumes. So you should always watch out for the spreads when you're trading, and that's for trading in general. Now, certain ETFs are geographically bound. So in the US, obviously retail traders have more selection, more choices of ETFs than, for example, a Canadian trader. Some ETFs that you could find in a certain country won't be available for purchase in another country. Also, company sizing boundaries are a thing. For example, if you're looking at a specific ETF that's tracking an industry, that ETF could be based on only a few and large stocks. So you want to watch out, and basically you want a well-rounded and a complete ETF. And lastly, we have management fees and brokerage commissions. This is more of a comparison between the ETFs and regular equity or regular stocks. Basically, when you're buying a stock, you have brokerage commissions. But when you're buying an ETF, you not only have brokerage commissions, but you have a management fee you have to pay to the company that's managing the ETF. So let's take a look at these two charts here. To the right, I have the SPX, which is the S&P 500 index, and to the left of it, I have the SPDR S&P 500 ETF. So the SPY here tracks the SPX, which is the S&P 500 here. And if we could look at the chart, it's actually quite similar. We have a low point here, which we have on the S&P here, and the general look of the chart, we could see that it really tracks it almost exactly. Now, there are some changes. If we could take a look here at the top, there's a 0.54% change, and for the ETF, and for the actual index itself, we have a 0.52 change. So there's obviously a small difference between the ETF and the actual asset it's tracking. But that's what we were talking about earlier in the video. The net asset value, the ETF is trying to track the actual asset as much as possible, and it's doing so pretty successfully here. I mean, we're very we're 0.02% of difference between the two, and that's basically what the manager does. He tries to make sure that the ETF tracks the actual index as much as possible. And why doesn't the ETF move away from it? Why doesn't the net asset value differ a lot from the actual asset? Well, that's usually taken care of by the what we call arbitrage. It's basically market making, and that makes in sort that the ETF, the net asset value difference between the two isn't going to be very big. Now, the actual index is trading at $1848.38, and the ETF is trading at 184.66. So we could see that's roughly a ratio of 10. So the actual index is 10 times what the ETF is worth, which is obviously the advantage. See, if you have a $20,000 portfolio and you don't feel like putting almost $2,000 on a single equity, you could buy the ETF instead, and you're going to have the same movements, the same performance. If the S&P 500 moves 50% in a year, the ETF that tracks the S&P 500 is going to move 50%. Obviously, there's going to be a small difference from what we just saw, but very minimal usually. So that's all for the video. I hope you guys learned a few things. Once again, these are the very basics of ETFs. There's a lot more to learn, but I just wanted to cover the basic fundamentals.